Hi. At the time I am recording this video in March of 2023, there is growing interest in foreclosures. Now, if you're just watching this for the first time and you've heard foreclosure for the first time, I don't want you to panic. There is no deluge of foreclosures going on out there. But perhaps after, say, a 10-year period of virtually no foreclosures are coming back some. There's a whole generation of people in the real estate industry who don't have any knowledge, any experience with foreclosures. And so there's growing demand for information about foreclosures. And as I present classes now on foreclosures, one of the questions I'm asked is, John, if I'm the listing broker, do I need to disclose that the property is in foreclosure? If you want to know more about the answer to that question, keep watching this video. So let's talk context first in answering this question. Some background before answering this question. So there's one concept in the law that real estate brokers, and in this case listing brokers, are not allowed to reveal their seller's motivation for selling. So that is a fact all by itself. That is a thing all by itself that suggests that you cannot reveal that your client is in foreclosure, at least if it's the reason for them selling. So a seller says to a listing broker, "We've got to sell this property. I'm 3 months behind in my mortgage payment. We got to move it before I lose my equity." That suggests you shouldn't disclose. But keep listening. Another key part of the context is there's also laws in Colorado that require listing brokers, whether they're sellers, agents, or transaction brokers, to disclose adverse material facts of which they are aware. There's a lot of mushiness about what that means, but one of the things that people pretty generally agree on, if there's something about the property that would adversely hurt, it's something about the property that would hurt, the reasonable buyer or most buyers, then it needs to be disclosed to the buyer. Well, what happens when those two notions conflict? Let's give an example outside the foreclosure context. What if the reason the seller is selling the property is the seller is nervous about the structural integrity of the property? Well, there's one part of the statute that says brokers cannot disclose the seller's motivation for selling. There's another part of the statute that says brokers need to disclose adverse material facts regarding the property. And the pretty solid consensus is the rule that wins is you got to disclose the adverse material facts about the property. The obligation to disclose adverse material facts about the property trumps, supersedes, overrides the prohibition against disclosing the seller's motivations for selling. Well, how does that play out in a foreclosure? We got to think about two different scenarios. Let's imagine one scenario where you are listing a property that you think the market will pay $500,000 for. Maybe you have an offer from a buyer for $500,000, and the debt against the property, the total debt against the property, first, second mortgages, are $400,000. $400,000. Market value, contract price, $500,000, total debt, $400,000. Well, the motivation for the seller to sell might be that the seller can't make the mortgage payments. However, this is not an adverse material fact for the buyer because there's nothing about that transaction that interferes. There's nothing about that math that interferes with the seller's ability to close. I would suggest to you that is a situation in which the listing broker does not need to disclose. They might choose to disclose. The seller might choose to disclose. I'll get to that in a minute. But I don't think the law requires a seller to disclose that the seller is having financial difficulties, that they've defaulted on the mortgage, that the property is in foreclosure, when the seller has plenty of equity to be able to close on the sale of the property without any risk of delay to the buyer. Let's contrast that example with another example. The property is selling for $400,000 and the seller has $500,000 of debt against it. That's a different story. That is a transaction, unless the seller has $100,000 plus to bring to the closing table to clear that deficiency, unless the seller has that kind of liquidity, which is an unusual event in a foreclosure scenario, then the seller is going to need cooperation from the seller's lender or lenders for a short sale, where the sellers agree to accept $400,000, less transaction costs, commissions, and title insurance premiums and other expenses associated with the sale. The seller needs a short payoff. And in those situations, I would suggest that the seller does need to disclose, you, the listing broker, do need to disclose to the buyer that the property is in foreclosure. Now, that isn't really a big deal. And the reason it's not a big deal is not only does the seller want to, not only does the law require disclosure of these things, adverse material fact, something that could cause delay, but a reason it's not a big deal is the seller also needs a contingency. The seller needs a contingency in the contract that reads something like, don't bother writing this down, I'll explain why in a second, but the seller needs a contingency that says something like, seller's obligations to close are contingent upon seller's lenders accepting the net proceeds of the sale in satisfaction of all the debt against the property. And that contingency is important because the real estate commission approved contract all by itself, without that contingency in it, has a provision in it that says if the seller's upside down, the seller's got to bring the bucks to close to clear the debt against the property. Now, the reason it's not worthwhile writing down what I just said about the contingency is the Division of Real Estate has created a contingency for you. They've created a whole addendum for it, the Real Estate Commission's short sale addendum. And among other things, that addendum does create a contingency letting the seller off the hook unless the seller's lenders approve the short sale. All right, there's another consideration in all this, and that is, regardless of what the law requires, you and your seller have the option of, in a way, being more conservative than what the law requires. Now, we do things like this all the time. We might be, driving through the mountains, and there's a 55-mile-an-hour speed limit, and every once in a while, it'll be dark, it'll be foggy, there'll be snow, there'll be ice, and we slow down and we drive slower than the speed limit permits us to do so. One of the things I encourage you to do when you're the listing broker, listing a property that's in financial distress, especially if the foreclosure has already been commenced, is to recognize two things. Number one, if the foreclosure has already been commenced, there is a good chance that the buyer will find out that the property is in foreclosure before closing. How? Well, the commencement of the foreclosure, part of the commencement of the foreclosure will be the recording of a notice of election and demand. And so the title company will see that recorded notice of election and demand, and the title company will include a requirement for the release of the notice of election and demand and the dismissal of the foreclosure as part of the closing. What percentage of your colleagues, what percentage of your buyers will notice that? I don't know. I don't know precisely, but I would imagine more than half will. So since the buyers are going to find out anyway, then it's just a question of, do you want to be preemptive and let them know? The second thing to consider is it might be in the seller's best interest to let the buyers know it's in foreclosure. Two reasons. One is, there's some reason why when companies are going out of business, they want to advertise going out of business sales. It's so advantageous, I'm not even sure it's true most of the time. But there is just this certain thing where we appeal to the, more greedy side of human nature. And we all like to think we get a steal on the property. And, maybe advertising that it's in foreclosure would actually help drum up competition for the property. But then there's another reason, and the other reason is especially in short sale situations, you don't want to waste your time with buyers who are impatient. Short sales take a long time to put together, And so you want to avoid wild goose chases, and it may be in this, just like it may be in your interest to drive slower than the speed limit, it might be in the seller's best interest to let the market know that the property is in foreclosure. If you do need to let the buyer know it's in foreclosure, by when do you need to let them know? And my answer, at least if it's a situation where the seller is upside down, when the seller is upside down, no later than the counter proposal stage. You get the offer, you respond with a counter proposal with the real estate commission short sale addendum, and that will satisfy your disclosure obligations. Ladies and gentlemen, thank you for listening this far. Remember, we live in a complicated world. Be careful, and look for foreclosure classes on the Educated Minds website. Catch you in the next video.